My name is Jake, welcome to the channel. In today's video, I want to talk about the Pareto Principle, also known as the 80-20 rule. On my channel, I've spoken with hundreds of people around investing and I've read thousands of comments. And I was thinking to myself, it's probably been over 10,000 comments that I've read over the last 4 years of creating investing videos here on YouTube. I created this channel to help new investors learn about the power of dividend growth investing. Here this year in 2023, my wife and I, we reached barista fire at the age of 37. So what this means is I'm no longer working a 9-to-5 job, but rather I'm living off of my dividend portfolio, what you see here on your screen here in M1 Finance, while also working part-time to fill the gap in the income that we need based off of our expenses. So that's a little bit about me. And what I've noticed over the last couple of years is that people generally tend to make investing a lot harder than it needs to be. And the more effort that we put into something doesn't always translate into a higher outcome or a better outcome or a better return. And that's what we're going to talk about in today's video is the Pareto Principle and how you can use the Pareto Principle to become a better investor. So let's talk about the Pareto Principle, which is also referred to as the 80-20 rule. The Pareto Principle was first observed in relation with wealth and population in Italy by Wilfredo Pareto in the early 1900s. Pareto found that nearly 80% of Italy's land was owned by 20% of the population. The Pareto Principle can have both social and economic implications, and the fundamental finding of Pareto's observation was that 80% of outcomes were caused by 20% of causes or efforts. And so consequently, by leveraging the Pareto Principle, it will help you focus on what's really important. As an example, I personally observed this while working as a sales director in my career over the last 10 years while working at large and small software companies. And I noticed that the gap in performance from the best performing sales reps was clearly seen by everyone. The best sales reps would usually get the best territories, thereby exacerbating the performance of low performing sales reps that were on other teams covering different territories. This would lead to the best sales reps getting the best leads and ultimately closing the most business and getting the highest commissions. Because the Pareto Principle was understood by sales management, this was encouraged and even promoted. The majority of sales reps would underperform and the best sales reps will be rewarded with luxurious trips like going to President's Club to Costa Rica. I would often ask the question, is this fair or is this just how the world works? Which then leads me to ask the question, how can we apply this in our own lives? One example that comes to mind in observing the Pareto Principle is with exercising and getting into shape, also known as getting rid of your dad bod, speaking from experience. Well, we know that 80% of outcomes come from 20% of effort, and that doesn't mean we completely forget the other 80%, but we should focus our time on what will lead to the most optimal outcome. With the example of losing the beloved dad bod, focusing on what will move the needle and produce the highest outcome should be your focus. So in this case, focusing on productive exercising and eating well will in most cases yield the highest outcome. For example, 20% effort will lead to 80% of the outcome. Everything else on top of that will fall under the 80% effort and 20% outcome. So how can we apply this to dividend investing? New dividend investors use conventional thinking that the hard way is the best and only way to invest in the stock market. For example, you might be overthinking and really overanalyzing using spreadsheets, really deep in stock analysis, listening in on the earnings call, reading dozens and dozens of blogs on how to invest, doing all of your due diligence. All of this will only lead to about 20% of the outcome. This is where the simple path to wealth with dividend investing comes in. Inspired by J.L. Collins, the simple path to wealth with dividend investing is focused on a core portfolio made up of low-fee index funds. Now you might be thinking, why mostly index funds and not individual stocks? Well, the answer is pretty simple. People are stupid and often make wrong choices. Take Steve Ballmer's first reaction to the iPhone, for example.
$500 fully subsidized with a plan? I said, that is the most expensive phone in the world, and it doesn't appeal to business customers because it doesn't have a keyboard, which makes it not a very good email machine. Now, it may sell very well or not. We have our strategy. We've got great Windows mobile devices in the market today. You can get a Motorola Q phone now for $99. It's a very capable machine. It'll do music. It'll do internet. It'll do email. It'll do instant messaging. So I kind of look at that and I say, well, I like our strategy. I like it a lot.
Oh my gosh. So how can we use the Pareto Principle with a simple path to wealth with dividend investing? Well, based on someone's investing time horizon, most people would benefit from an 80-20 portfolio. Have you noticed a pattern yet? 80% of the portfolio will be made up of low-fee index funds like SCHD and DJRO, and 20% will be made up based on the investor's personal goals and investing time horizon. This type of portfolio construction is sometimes referred to as the core and satellite portfolio. So by having 80% of your portfolio in SHD and DJRO, you're spending 20% of your time and effort, which should generate 80% of your investment's outcome. The remaining 80% of your time will only yield you 20% of your investment outcome. This shouldn't be considered as the only way, but as a guide to help you focus on what will drive the most optimal outcome. If you're thinking of doing the opposite of what I'm suggesting and focusing on individual stocks instead of index funds, the data suggests that you may want to reconsider. Let's take a look at active versus passive investing. So in order to do that, what we're going to do is we're going to look at the SPIVA. This is the Standard & Poor's indices versus active. And what this is looking at, it's looking at actively managed funds compared to their respective indices. And what you can do is you can compare this on a global level, on an individual country level. But for this purpose, we're going to just look at the S&P 500. Okay, and so in looking over different time horizons, 1 year, 3 year, 5, 10, and 15, you'll notice that the difference in the outperformance will change over time. And so we have what's called recency bias. If we outperform the market, or if we are invested in a fund manager who outperforms, we think that that will continue. That's called recency bias. And that's not really in your favor over the long term, okay? So over the last year, fund managers have been able to outperform the index, the S&P 500, at a rate of 39%. This is actually pretty good compared to historical numbers. Now, with the changing environment that we're in with higher interest rates, I'm curious how that's impacted things, but nonetheless, this is what the data is showing. If you look at that over 3 years, the number goes down dramatically. Only 20% of active fund managers are able to beat the market. If you look at 5 years, only 13% beat the index. Over 10 years, only 14% of fund managers actively managed outbeat the S&P 500. And then lastly, over 15 years, only 8% of actively managed funds beat the S&P 500. If you think that just because Warren Buffett picks stocks and beats the index and you're going to do the same, you probably should rethink or reconsider your strategy. It's not impossible, but the odds are stacked against you. Like Steve Ballmer, you and I can't predict what the world will look like in the future. By following the simple path to wealth with dividend investing, you acknowledge the Pareto Principle and accept that 20% of your effort will result in 80% of your investment outcome. Ultimately, by understanding the Pareto Principle, it will help you make better investment decisions and stay focused on what's most important to you. And just imagine what you can spend your time on when you aren't worried about your investment portfolio. Thanks for watching.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.